Private investors, asset managers, REITs. Real estate investors come in different shapes and sizes. Today, I'm going to talk about some of the most prominent types of real estate investors. Hey everyone, this is Jenny from Real Estate English Academy, the place for real estate professionals to boost their English. Today, in part 1 of our 3-part series, I'm going to talk about different types of real estate investors. We'll look at what these investors do, and I'll give you some specific terminology that you can use to boost your English when talking about real estate investment. But before we dive in, please subscribe to our channel and hit the bell button to turn on notifications if you want to see more videos like this one. And if you want to test your knowledge of investor types, click on the link in the video description and take our quiz. Let's start off by talking about the difference between private and institutional investors. The term institutional refers to investors that invest on a large scale. Typical examples include mutual funds and investment banks. Institutional investors typically exhibit high liquidity, which means they have a lot of money available for investment, and the capital they invest is not their own, which means they are investing on behalf of other people. Private investors are frequently also referred to as retail investors. Private or retail investors are private individuals who are looking to invest their own money. Private investors might purchase properties for themselves to live in, or if they have more capital available, might invest in several residential or commercial properties, which they typically hold to earn regular income. In some cases, private investors might be high net worth individuals who are able to invest on a large scale. Many high net worth individuals, however, do not handle their investments themselves, but instead turn to an asset management firm or a family office. Family offices are private wealth management firms specifically dedicated to managing the funds of high net worth individuals. Family offices provide end-to-end outsourced solutions, which means they do it all, from advising, managing finances, and handling investments. The advisory services offered by family offices include matters such as budgeting, insurance, donation, business, and wealth transfer services. Today, there are 2 main types of family offices: single-family offices and multi-family offices. Single-family offices are the more traditional form and focus on providing all of these services to just one high-wealth individual or family. Multi-family offices provide services to multiple families and are becoming increasingly popular, perhaps in part because they tend to be the less expensive option, as they're able to tap the synergy effects created from doing the same tasks for multiple clients. Now let's talk about asset management firms. Asset management firms manage funds for both private and institutional clients. Asset management is the systematic process of developing, operating, maintaining, upgrading, acquiring, and selling assets in the most cost-effective manner. Asset managers make well-timed investment decisions on behalf of their clients to grow their clients' finances and portfolios and to maximize income. They also seek to diversify their clients' portfolios in order to reduce cluster risk. Reducing cluster risk means focusing on a variety of investment categories, like different types of real estate, stocks, bonds, and commodities, so that their investments are not grouped together as a cluster in one category, making those investments less susceptible to market fluctuations. The last type of real estate investor we're going to talk about today are real estate investment trusts, or REITs. REITs were introduced in the United States in the 1960s as a way to enable investors to buy shares in commercial real estate portfolios and participate in the income generated by a variety of different properties. Their structure is similar to that of a mutual fund, which is open to both large and small investors. Most REITs are structured as equity REITs, which buy, own, and manage income-generating properties. Equity REITs take the money provided by investors and use it to purchase and, in many cases, manage or improve real estate that is let to tenants who pay rent, thereby generating the income that is then distributed to the investors. Equity REITs often focus on a specific real estate segment, such as a certain industry or region, but some may offer a more diversified portfolio. Another type of REIT is the mortgage REIT, or MREIT. Mortgage REITs focus on lending money to property owners and operators, either directly via mortgages and loans, or indirectly by acquiring mortgage-backed securities. The third type of REIT is the hybrid REIT, which combines both income-generating properties and mortgage loans. Because these are a combination of equity and mortgage REITs, hybrid REITs give investors the opportunity to participate in multiple types of risk. Already familiar with one or more of these investor types? If so, tell me about your experience in the comments below. Thanks for watching, and don't forget to apply the terms you learned today to your own real estate English. See you next time.